You know, Dollar General, it's one of those stores that feels like it's just everywhere, right? A familiar part of the landscape. But today, we're going to look at it through a completely different lens, the investor's lens. We are going on a treasure hunt to figure out if this everyday retailer is actually a hidden gem for your portfolio. So let's get into it and see what we can find. So this is the big question, isn't it? I mean, a lot of investors are wondering about this one. The stock's taken a hit from its recent highs, so you have to ask, is this a golden opportunity to buy into a great American business on the cheap? Or is there something kind of troubling lurking just below the surface? It's time to start digging and see what the data really tells us. Okay, before we dive into all the numbers and valuations, we've got to understand the game plan. You just can't value what you don't understand. Simple as that. So let's open up the Dollar General playbook. You know, the real beauty of Dollar General's whole model is its simplicity. I mean, it is so disciplined. They've got this massive network of small stores, and they very deliberately put them in rural and lower income areas that, bigger retailers like Walmart or Target just tend to ignore. They sell stuff people need to buy again and again, consumables, which just keeps people coming back. The entire strategy is built on turning over inventory super fast and keeping costs brutally low. But, and this is a big but, look at that last point. Those profit margins are getting squeezed. And that is the central mystery we've got to solve today. Yeah, and that whole profitability problem, it leads us right into the company's financials. And what we find there is this really fascinating story of two completely opposing forces. It's kind of like a tale of two trends. So here it is. This is the core conflict right here. On one hand, people are absolutely still shopping there. Sales have been growing steadily year after year, which tells you the basic business is still incredibly relevant. But on the other hand, the company is making less and less profit on every single dollar of those sales. And for a business like this, one that's built on having super thin margins to begin with, well, that's the storm cloud we need to keep a very, very close eye on. And wow, this chart right here, it just perfectly illustrates how serious that problem is. Just look at this trend. A decade ago, the company was keeping about 5.5 cents of profit for every dollar in sales. Pretty good. 5 years ago, that dropped to just under 5 cents. And in the last year, it's plummeted to just 3 cents. That is not a slow leak, my friends. That is a huge drop, and it signals some very real pressure on their operations. Okay, so just when things are starting to look a little bit bleak, our investigation uncovers a hidden clue. It's a really positive sign tucked away in the financial statements that kind of tells a different story about the company's real underlying strength. And here it is, $2.34 billion. That is their free cash flow over the last year. Now, what's free cash flow? Well, think of it as the cold, hard cash the company has left over after paying for everything. All its operations, all its investments. It's the money it can use to pay down debt or buy back stock or just stash away for a rainy day. This number, this is a powerful sign of health, showing that even with all those margin issues, this business is still an absolute cash-generating machine. So we have this fascinating tension, right? We've got a powerful cash-generating business model that's also clearly under a lot of pressure. This brings us to its competitive advantages, or what a lot of investors call its moat. Let's see how well that moat is holding up against the current siege. This table, man, it just lays it all out with some brutal honesty. If you look at that weighted score column, you can see the whole story of Dollar General right now. Its biggest strength, its massive scale and efficiency, that gets a positive score of 0.60. But its biggest weakness, that margin compression we've been talking so much about, gets a negative score of 0.60. It completely neutralizes it. This is the tug of war that makes this such a tricky investment case. The company's powerful moat is being directly challenged, and honestly, the outcome of that battle is far from certain. Okay, so we get the business, we get the financials, and we understand the battlefield of its strengths and weaknesses. Now it's time for the million-dollar, or I guess in this case, billion-dollar question. What is Dollar General actually worth? The hunt for intrinsic value is on. Now hold on, before we throw a number out there, it is so important that we all understand what intrinsic value actually means. It's not the stock price you see flashing on your screen. No, it's the estimated underlying value of the entire business, based on all the cash we think it's going to generate for the rest of its life. It's our best estimate of what that treasure is truly worth. So, after all the number crunching and projecting future cash flows, this analysis lands on a blended intrinsic value of $173 per share. Now remember, this is not a price target. This is what the analysis is saying each share is fundamentally worth, based purely on the long-term cash-generating power of the business itself. But listen, that 173 number, it's not set in stone. It's just an estimate, right? And this slide shows us a range of possibilities depending on how the future plays out. In a pessimistic bear scenario, what if those margin problems just stick around and cash flow drops? Well, the value could be as low as $120. But in an optimistic bull case, where the company gets its groove back and margins recover, the value could soar all the way to $220. Our 173 base case, it sits right there in the middle, assuming things get better, but maybe not all the way back to the good old days. Knowing what a business is worth, that's only half the battle. The next step, and, it's arguably the most important one, is figuring out the right price to pay to actually hit our investment goals. So let's see how the analysis breaks this down for us. This table right here is incredibly powerful because it connects the price you pay today with your potential return in the future. Now, the source analysis is aiming for a 9% annual return over the long haul. To hit that goal, based on that 173 intrinsic value, the absolute max you can pay today is $150. If you pay less, say $135, your potential return jumps to 10%. But if you pay more, your future return starts to shrink. See? It puts you in control. And here's one more really important layer to think about: your time horizon. As you can see, time is a powerful ally for an investor. The longer you plan to hold the stock, the more you can technically afford to pay for it today and still hit that 9% return, just because you're giving your investment more time to compound. But if you're only in it for 5 years, you have to be way more disciplined with your entry price. All right, we've inspected the business model, we've audited the financials, we've calculated the value, and we've identified our potential entry points. It is time. Let's put all these clues together and deliver the final verdict. Is Dollar General a treasure or is it a trap? I think this quote from the source analysis just captures the situation perfectly. The business isn't broken, not at all, but the challenges are very real. And that feeling of certainty, it's just faded. It's kind of like we found a map to a treasure chest, but now we can see the path is way more treacherous and has more obstacles than we originally thought. And so the final verdict from this analysis is a hold. At its current price, it doesn't look like a screaming buy, but it's not a sell either. What it suggests is that the real opportunity, the moment to pounce, would come if the price drops below $135. Now, why that number? Because that would give you a much bigger margin of safety, which is an investor's best friend, to protect against all those risks and uncertainties we've been talking about. So let's wrap this up. What are the key takeaways from our treasure hunt? First, Dollar General is a strong, durable business, but it's facing some very real headwinds that are hurting its profitability. Second, the analysis shows it's modestly undervalued today. But third, the risk is that there really isn't much room for error here. And that brings us to the most important point of all. The treasure is only truly unlocked if you can buy it at a significant discount, below $135, according to this analysis, which gives you the protection you need in case that turnaround takes a lot longer than expected. And that's our deep dive on Dollar General. The map is drawn, and the potential hazards are all marked. Whether you decide to start digging for that treasure, well, that's up to you. Now, I want to hear from you. What companies should we put under the microscope next? Let me know down in the comments. Thanks so much for joining me on this investigation.